Do fixed income investments suddenly look more attractive given the market volatility right now? What is the best way to invest in equity considering the new tax regime? And the last question, and a really important one, are ULIPs actually worth taking a look at once again, given all these big changes? Well, these are just some of the many issues that we will address over the next half an hour. My guests on the show are Ashok Agarwal, Head of Research at Bajaj Capital, and tax expert Amit Maheshwari. Gentlemen, thank you so much. It's good to be in Delhi. Of course, it's budget season, right? So I thought a trip to the city is really worthwhile. Good to talk to both of you here. Amit, let's start with you.
Yeah.
Your opening thoughts. I mean, a lot of investors, savers, regular salaried, earners are feeling fairly disappointed because they're like, "Arey, kuch extra to mila nahi." Upar se now we have this LTCG regime kicking in. Your thoughts?
Yeah, so you are right. If you look at the standard deduction which came at 40,000, then they took away some allowances. So basically, you end up getting no incremental cash flow in your hands. And the LTCG gains, which is over a longer period, will have quite a lot of impact on the retirement corpus of individuals, is actually a dampener, especially considering when we were all moving towards financial instruments rather than real estate and gold, which have been our traditional investment classes. So it's been a dampener, yeah.
Okay, so let's talk about the modalities of how this is going to play out. And I was also looking at a lot of the fine print. So it's very clear, right? At least for the next month and a half, I mean, till the 31st of March, you can buy, sell at will. There is no tax that applies. It all kicks in after April 1, right?
Yeah, it kicks in from 1st of April 2018. And any shares held before 31st January 2018, the capital gains are basically grandfathered up to 31st January. So that's how it plays out.
Okay. And what about things like, offsetting the loss? Because till now, if you had a long-term loss after selling shares or mutual funds after 1 year, even if you, ended up losing money, there was no offset. Is that going to be available? If that's the case, where can you offset this loss?
So actually, as per the existing tax regimes under Section 1038, all these losses were related to an exempt asset class. But there were several tribunal judgments where they had taken a view that there could be a situation where these losses could be set off. But the majority view was that you cannot use these losses to set off for any other taxable capital gains. In the FAQs which have come in, they have very clearly said that before 31st January 2018, all your losses which have arisen from these equity shares as well as equity-oriented mutual funds, they cannot be set off.
Okay, so any past losses, that's an important clarification.
Yes.
Just like you get the grandfathering benefit that your past gains are secure, you also can't have it both ways. You can't use past losses and then offset that against a tax liability, right?
Yes, but starting from 1st of April, all your losses can be set off.
Okay.
So from 1st April, so it makes sense not to sell your shares right now. If you want to book losses, do it on 1st of April so that your losses can be set off against your future taxable profits.
Okay. But let's also bring in Mr. Agarwal into the conversation. Yeah. So your thoughts, sir. I mean, a lot of people are wondering, I'm sure clients would have been calling you up as well, especially those who are holding equity via mutual funds, shares. Do you think that it'll be prudent to book a lot of your past capital gain? Are you expecting a lot of churn in investment portfolios because of this?
There have been some rumors and concerns from clients, but what we are educating them on is that since the gains till 31st of January are already grandfathered and you don't have to pay taxes on that, so there is no point. There is no point in booking profits before that, because anyways till 31st January whatever you have made is not taxable, and it depends how much extra gains or incremental gains you make in February and March. It doesn't make sense to actually jump the gun and just go ahead to book profits before that.
So in your mind right now, what does this change? The fact that there is a 10% tax, and let's also talk about dividends. I mean, till now we were very used to enjoying absolutely tax-free dividends every time a mutual fund send you that lovely message, but now that dividend is also taxed at 10%.
Yeah, so a lot of people who are depending on dividend income from equity mutual funds, they will suddenly find their dividends being taxed at 10%. So that reduces the relative attraction of equity mutual funds vis-a-vis debt mutual funds in the short term, means for dividend options, people who are opting for dividend income. The long-term capital gains tax basically reduces the expected returns from equities,
Absolutely.
the post-tax returns. So earlier, if you were expecting around 13% kind of returns from equities, now you can expect 11.7% returns.
Absolutely. So, which is why I think a lot of people will go back to the drawing board. Also, markets being extremely volatile. Earlier, it was a no-brainer. If you had spare money, I mean, equity was just the best asset class to be in because there was no tax hassle. So, Amit, on that, just compare where we stand with respect to taxation, the three key asset classes, equity, debt, as well as real estate. So just from a taxation point of view, where is there, I mean, is there absolute parity now? Where are the anomalies, if any?
Yeah, so real estate is actually taxed at 20%. Long-term capital gains on real estate taxed at 20%.
And the definition of long-term there is 2 years, whereas for equity it's still 1 year.
Yes, for listed equities, 1 year. So your real estate gets 20% tax rate with indexation. So that's a key part. So you get an indexation benefit, considering India is a high inflation society. And your debt mutual funds, there also you get indexation benefit. And there the tax rate comes to again 20%. For equity, your tax rate now for equity shares as well as equity mutual funds has now become 10%, but without indexation.
Without indexation.
So if you have a situation where obviously in equity as an asset class beats inflation, but if you have a situation where probably in next couple of years, considering the highest stock market levels, you have a situation where your equity returns don't beat the inflation, then you potentially paying capital gains without having an actual net of inflation return.
So Mr. Agarwal, then, thoughts with you. Do you think there will be a significant amount of rethink on the asset allocation? Tax is, of course, one element. The second is just the way the market is moving, volatility, the way bond yields are moving, interest rate expectations. Do you see a change in portfolios with respect to asset allocation at all?
See, asset allocation is a much broader term, and it is normally aligned in line with your goals and your risk profile. So, despite long-term capital gains tax, equities still remain the best performing asset class when it comes to beating inflation in the long term and enjoy the best rate of compounding over the long term. So if you have a long term goal anyways, you don't need to reduce your allocation to equities. You can do either two things. One, reduce your return expectations.
Nobody likes to do that.
No, but that's a reality
well, that's
that
a reality
we have to
of
face.
Life. Yes.
So either if you want to get the same amount, say after 20 years, then either you increase the investment amount at this point in time, or you just shift your goal from 20 years to say 22 years. That's just a back of
you increase the
so if you want to get the same amount. So these are the two things that you need to do. You don't need to change the asset allocation, but yes, after this LTCG, people are thinking over changing the mix or the avenues through which they can invest in
You
equities.
hit the nail on the head, because that's exactly the conversation that we now need to move to. After the break, the very, very important question. Of course, you need to be in equities. The question is, which is the best, most efficient product? Is there a case now with the introduction of LTCG tax on mutual funds? Is there a case to start looking at ULIPs all over again? That conversation coming up on the other side.
Commenced operations in 1987 as a single doctor clinic in Dubai, now having international presence in 8 countries and a growing presence in India. Aster DM Healthcare Limited. Public issue of equity shares of rupees 10 each through the book building process in the price band of rupees 180 to rupees 190 per equity share. Bid offer opens on Monday, February 12, 2018, and bid offer closes on Thursday, February 15, 2018. For risk factors and other details, please refer to the Red Herring Prospectus available on the websites of SEBI, BSE, NSE, GCBRLMs and the BRLMs to the offer.
Welcome to Gabon, an African hub that is a gateway to the region. More than 40 years of institutional stability driving the business environment. Established special economic zones, world-class ports and infrastructure facilities. We are open for investment. Gabon calling.
Congratulations, Rahul.
Thank you.
आज से ये चेयर तुम्हारी.
It's an honor, sir. But sir, इतनी बड़ी जिम्मेदारी, पता नहीं स्टाफ मुझे पसंद करेगा कि नहीं.
तुम उनका ख्याल रखोगे ना राहुल, तो वो तुम्हारा और कंपनी का ख्याल रखेंगे. Here's a good way to show you care. LIC's pension and group scheme. पेंशन, ग्रेच्युटी और रिटायरमेंट बेनिफिट्स आसानी से मैनेज करता है।
मतलब एम्प्लॉइज खुश तो कंपनी भी खुश।
सेंचुरी फ्लैग, सब सही, मस्त रहे।
Missing that beautiful view from your balcony? Home loans from PNB Housing. Surprisingly easy.
Get your kitchen to the next level of luxury with Architect drawers. Hetic fittings make your furniture work beautifully. German quality you can trust.
राखी के साथ साथ तेरी गालियां भी तो मिस कर रहा था।
हम जानते हैं पैसों से बढ़कर है अपनों की नोक-झोंक, इसलिए आरबीएल बैंक चैट पे चैट करते करते पैसे भेजने का आसान तरीका। आरबीएल बैंक, अपनों का बैंक। Welcome to Gabon, an African hub that is a gateway to the region. More than 40 years of institutional stability driving the business environment. Established special economic zones, world-class ports and infrastructure facilities. We are open for investments. Gabon calling.
Every morning on CNBC TV 18's Bazaar Morning Call, data gets transformed into expert insights that drive decision making.
I don't watch business channels. If I do watch, I watch CNBC.
Any market moves because of liquidity.
The Asian screen is green.
The market has done remarkably well.
Stocks expected to be under pressure today.
The market is heading up.
For policymakers, CEOs and decision makers.
The first channel I put on is CNBC TV 18 because I want to know the business news.
From minute-by-minute analysis to expert inputs and global views, you get the news before it hits the trading floor. Bazaar Morning Call. At these times, only on CNBC TV 18.
Morning Call brought to you by HDFC Life.
Welcome back. You're watching Money, 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 and we are coming to you from New Delhi this week around. The conversation centers around, of course, this new era of the LTCG tax and what you need to do. Mr. Agarwal, very rightly, as you said just before the break, I think a lot of people are now wondering that on mutual funds, suddenly there's a 10% tax and there's a tax on dividends as well. No such change for, market-related or market-linked insurance products, ULIPs primarily. Is there a case to go back to that, comparison, that example at all? Because ULIPs had become a so-called bad word, a couple of years ago.
Yeah, so ULIPs actually, they used to be very high-cost products. And that is one reason why between the period from 2008 to 2000, probably 12-13, a lot of people actually got disenchanted with ULIPs because of the high cost structure, because when they finally got their amounts, they were surprised by the very low amounts, right? But I believe in the last 3-4 years, the regulator IRDA has done a lot of changes in the cost structure of ULIPs, making it much more transparent and much more cost effective. Okay. Till this long-term capital gains tax on equities came, equity mutual funds were still a better investment as compared to ULIPs when it came to investing in equities, right? But this LTCG has been a kind of a game changer. It has reduced the relative attractiveness of equity mutual funds vis-a-vis ULIPs when it comes to giving returns from equities.
I'll tell you what, of course, there's merits and demerits. You have to look at a product not just because of the absolute return. things like suitability and complexity of the product. We'll come to that in a bit. But if we look at the pure math, the one argument that's constantly thrown back at me is that ULIPs have much lower fund management charges than pure equity mutual funds. So therefore, maybe there is a case to look at them. Do you agree with this argument? And what about the other charges that go inside a ULIP?
Right. Yes, I do partly agree with that, because in pure equity mutual funds, the costs are the expenses. Fund management charges are generally about 2.2, 2.3, but post some SEBI regulation, recent SEBI regulation, they are likely to come down to around 2%.
Okay.
Whereas for
2%
ULIPs,
of your corpus.
Of your corpus, fund value at any point in time, right? For ULIPs, IRDA has kept the fund management charges at 1.35%. So there is an incremental difference or saving of 0.65% of the fund management charges.
Correct.
I agree that ULIPs have a lot of other costs, insurance related costs, premium allocation charges, higher commissions to pay to the agents or brokers. But then we have to see that those charges, and yes, they are front loaded too, but we have to see that those charges are levied on a very low base. They are levied on the premium, the annual premium. So for example, if you are paying 2.5 lakh rupees of annual premium for a 25 lakhs of sum assured, then whatever premium allocation charge, it varies from 0 to say 6%. So 6% is of 2.5 lakhs, right? Then you have got mortality charges. Now that is a function, say 0.14%, up to say 0.5% depending on your age. That is a function of the sum at risk, right? And it comes out to be very low. Policy administration charges is another expense, but again that is fixed at say 30 rupees per month going and capped at 500 rupees per month. So that is even lower. The fund management cost is the fourth cost that you have in ULIPs, and that is 1.35%. So all the three costs which are not there in mutual funds are actually charged on a lower base, and they keep on diminishing with time. So these costs won't be the same in the first year and the fifth year of a ULIP.
So, Mr. Agarwal, I get your point. I mean, I think pure mathematics is now adding up perhaps in favor of ULIPs. So, it's almost neck to neck between mutual funds and ULIPs. But beyond math, the other factors that people should consider and keep in mind while making this all-important choice of, getting into the equity market through one of these products.
So there are 3 or 4 other factors that one must keep in mind. One is of course liquidity. So even if you consider ELSS mutual fund schemes, then the liquidity, it's anytime liquidity after 3 years, because there is a 3-year lock-in period. If you are not considering any ELSS mutual fund scheme, any other diversified equity scheme, then the lock-in is just, the exit load is just for 1 year, and beyond 1 year, there is full liquidity. Whereas in case of ULIPs, you cannot basically surrender or redeem it before 5 years. So the liquidity starts beyond 5 years. So one is liquidity. Second is suitability. So in ULIPs, we have a very critical component called mortality charges, wherein if the age of the investor, and we have seen it typically, crosses 40, then the mortality charges see an exponential increase, due to which the returns, the costs suddenly increase, and then ULIPs become unfavorable vis-a-vis mutual funds.
That beneficial.
Correct.
Like
so in terms of whereas equity mutual funds don't have any age barriers or anything like that.
Invest at any
anytime
point,
and redeem and at any point in time, all the charges are equally applicable. The markets don't differentiate whether you are a 60-year-old or a 20-year-old. So basically, if a person is aged up to 40 years, ULIPs and mutual funds, the choice is almost same depending upon your goals and objectives and investment horizon. But if you are beyond 40, then equity mutual funds definitely are a better thing. The third point and very critical point is fungibility. So there are 2 kinds of fungibility. One is intra-manufacturer fungibility, and one is inter-manufacturer fungibility. For example, within the same insurer, if you want to shift from one scheme to another, suppose one particular scheme's fund manager is not performing, or one particular asset allocation does not suit you, then you can do a free switch from one scheme to another, or one asset allocation to another.
But within the same insurance company.
Within the same insurance company, and there are a certain number of free switches allowed per annum or over the tenure of the policy. Whereas in case of mutual funds, even if you switch from one scheme to another scheme of the same AMC, you have to pay the exit load charges if applicable in the first scheme, in the original scheme, and then you are also liable for taxes, whether it is STCG, short-term capital gains tax, or long-term capital gains tax. Coming to manufacturer fungibility, here mutual funds score over ULIPs, because in ULIPs you can't just move on, means portability is not there.
You
can't just move
on.
You have to surrender the policy, close the
policy
policy and then move on. Then there are costs and other issues attached to that. Means your premium amount will drastically increase if you wish to change after 5 years. Because then you become 40 years old rather than 35 years old, and the entire mortality charges calculation goes haywire. Right? Whereas in case of equity mutual fund schemes, provided you are you have already crossed the exit load period and you are willing to pay the capital gains taxes rather, you can anytime switch from one particular AMC to another. So there is absolute portability with a very minimal cost over there. So these are the three things. So one should always keep in mind these three factors. See, tax is a bad tool. Just using tax is a bad way of judging which investment avenues one should go through. There are a lot many things one has to be. It can't be
absolutely.
It can't be a this versus this.
Absolutely.
We are actually starting the wrong.
Amit, your thoughts on this? Because at one hand, this was the budget where the life insurance industry was actually crying for a carve out from ATC and a separate limit for term insurance, etc. None of that has happened. Any other thoughts on taxation with respect to insurance?
No, I think I perfectly agree with him, and it looks like ULIP will now again be back in the flavor, and let's see how. But as far as I know, that SEBI has a recommendation of reducing the charges for mutual funds. So maybe we will have to see how that happens. But yes, from a tax perspective, ULIP definitely have that tax advantage over the equity mutual fund.
And of course, the only other added point that changed this time around, I think, for insurance was health insurance for senior citizens. There, the limits have been increased slightly,
so that health insurance has increased from 30,000 to 50,000. And then if you have specified diseases, then again for senior citizens, it has gone up to 100,000 rupees. So those are some benefits which people have got.
Slight benefits for senior citizens at least. Okay, fair enough. We will take another quick break on that note. The conversation continues. All the key takeaways from Budget 2018 encapsulated for you on the other side.
हम मानते हैं कि दुनिया को बेहतर बनाने के लिए जरूरी है एक सोच कि दुनिया बेहतरी के रंगों से निखर सकती है, एक सोच कि अच्छाई के रंग हम सब पर खिलते हैं, एक सोच कि ये रंग जब फैलेंगे तो खुद में खुशियां समेट लाएंगे, और इन्हीं बदलाव के रंगों को हम आपसे शेयर करते हैं उस सोच के साथ जो जाती है हैप्पी रेनबो बॉक्स में।
A bond that makes you smile starts with the Happy Rainbow Box. Shri Infrastructure Finance Limited now offers public issues of NCDs with interest up to 9.5% per annum. Rated AA+ by Brickwork, a separate category for trusts and societies. Issue opens on 9th Feb 2018. This is for advertisement purpose only. For risk factors and more details, please refer to the Shelf and Branch 1 prospectus dated 5th Feb 2018.
Welcome to Gabon, an African hub that is a gateway to the region. More than 40 years of institutional stability driving the business environment. Established special economic zones, world-class ports and infrastructure facilities. We are open for investment. Gabon calling.
Orient Aerostorm with the highest ever 300 cmm air delivery. Very powerful, very silent. Aero series fans. Orient Electric. Switch to smart.
I want to buy a 1 BHK flat by the end of this year, but I don't know if it's the right time.
Do I need a real estate agent or can I buy the property directly?
Do I need insurance for my new home? I mean, is it really required?
Under construction properties are much cheaper than the ready-to-move-in ones, but you never know about these possession delays. So what should I choose?
I want to build my first home in my village. How is a land loan different from a home loan?
Need help in buying your first home? We'll help you make the right choice.
Today, demand and supply is the only important parameter that is driving any micro market in terms of appreciation.
We will help you take the best bets with your property buys based on location and supply ratings for key markets across India.
Send your queries to home@nw18.com. first-time home buyer, your search for the perfect first home ends here. At these times. Only on CNBC TV 18.
First-time home buyer, powered by LIC Housing Finance Limited. Building homes, nurturing relationships.
Welcome to Gabon, an African hub that is a gateway to the region. More than 40 years of institutional stability driving the business environment. Established special economic zones, world-class ports and infrastructure facilities. We are open for investment. Gabon Golly.
Welcome back. You're watching Money, 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 and this week we are encapsulating all the key takeaways from Budget 2018 for you. So, Amit, jog our memory. Are we missing out anything? You did mention standard deduction earlier, but I think the final understanding was that I think now transport allowance, for instance, goes away. So, what is the real benefit, if any?
Yeah, the benefit is very minuscule. You have your medical reimbursement and transport allowance going back, so you hardly get less than 5,000 rupees as the benefit per year. But you have a higher cess which is gone from 3% to 4%. So you basically end up getting nothing. So the long-term capital gain is definitely going to hit the savings and the retirement corpus of individuals, because we are saving from, we are moving from real estate to financial instruments. One key thing which we have missed, I think, is the stamp duty value. So you earlier, when you had capital gains, the stamp duty value,
when you were selling a property,
your stamp duty value was taken as the sales consideration if your sale consideration was less than that. But in certain cases, when you have house properties which are inside your slightly inside the locality, which don't command the median rates, so then your value was slightly less than the stamp duty value, the actual transaction value. So now they have said if it is within 5% of the stamp duty value, they will allow you to take the actual sales
actual value. So you get that much of sort of a, let's say, discount to the stamp duty rate. As long as it's within 5%.
Yeah, for capital gain purposes.
Okay.
Another thing which has come in, that when you file your tax returns, every return gets mandatorily processed by the tax department under section 143. So any mismatches between your tax credits and your income get added to your income automatically. That was the process which was going on. So you used to get a notice and you had to reply. So that has gone away. So that's a good thing, because we had hundreds of notices getting issued for mismatches of every kind. So I think more than that, I think the biggest change has been the LCCG, which I think we have been discussing.
And no rollbacks, at least as of now. The government isn't promising any kind of a rethink, not immediately. Final thoughts, Mr. Agarwal. I mean, for you, what has been the big takeaway? And, if you look at the next 1 year, does the budget really do anything meaningful, any kind of meaningful change in terms of personal wealth and personal finances?
So in terms of personal finances, means I think all the goodies have been reserved for the senior citizens. So my dad would be a happy man now, because
the interest, the exemption that you get on bank
interest income, that has gone up from 10,000 to 50,000, and his Mediclaim insurance deduction limit has also actually gone up by from 30,000 to 50,000, and again no TDS will be deducted on his interest income from bank FD. So these three things are very positive. Standard deduction means not all employees are getting all these transportation allowances or medical reimbursements. So guys like us would be happy with a 40,000 standard deduction. We don't have these medical reimbursement limits. Apart from that, see, one very important development in the budget was government's focus on developing the corporate bond markets. So one, they proposed to launch debt ETFs. So that will bring in much more investable options for a saver, or a financial saver, basically in the debt space. Second is the government has said that it will mandate the regulators to consider A-rated corporate bonds as investable for certain institutions that are controlled by those regulators, that are regulated by those regulators. So we may see more liquidity flowing in the A-rated corporate bond market. As regards means this LTCG debate has thrown up many other issues, like whether if you should invest in debt funds or equity funds. I think that's again a wrong thing to talk about, because whether you should go for debt or equity depends on your risk appetite.
It's an asset allocation mix. It's your own personal
It depends on your risk appetite. Just because you are getting slightly lower taxes You can't just go for equities when your investment horizon is 2 years, because equities, you forget about the volatility.
Sure.
Right? So I think these decisions should not be actually based on just incremental post-tax returns.
I take your point. I think the takeaway from our discussion is that be alert, be mindful, do your calculations, look at the changed taxation scenario, but don't jump the gun. Don't be trigger happy. Think about all things and then come down to your investment decisions. Thank you very much, Mr. Agrawal and Amit, for joining us today. Great talking to you as always. That's it on this week's episode of Money, Money, Money. Your feedback, comments, queries, welcome as always. We'll see you again next week.